This is a BC Eagle accounting video. Absorption costing versus variable costing. Now, in illustrating the idea behind variable costing and why it's important, let's take a simple example of making bricks. You know, the type of bricks that go into houses and roads and walkways. Now, a brick is very simple. It's made up of some raw materials, which consist of cement, some sand, some stone, and a little bit of fly ash to hold the whole stuff together. Now, once these materials are put together and formed in the shape of bricks, the bricks are loaded on a pallet, and the entire pallet is run through, in this case, a giant tunnel kiln, which fires the bricks so that they become stable. So here is the setup. Let's suppose that brick materials, the cement, the sand, the stone, and the fly ash, cost $1 for each brick that you make, and the tunnel kiln that fires the brick would cost $100,000. And let's just suppose that this kiln is entirely expired at the end of 1 year, so it has a depreciation life of only 1 year. Now, what we are trying to illustrate is that variable costs, direct material and direct labor, are driven by decisions about the volume of activity. If volume goes up, variable costs go up in total. If volume goes down, variable costs go down in total. Fixed costs, on the other hand, are driven by decisions about time. In other words, if we make 1 brick during the first year, or if we make 1,000,000 bricks during the first year, the overhead cost for the depreciation on the tunnel kiln will still be $100,000 in each case. Here is the key to variable costing. What variable costing attempts to do is to isolate those costs that are driven by volume, variable costs, from those costs that are driven by time, fixed costs. So let's illustrate. Let's compare the full absorption GAAP accounting to variable costing and how each would work. GAAP accounting, as you know, is designed for inventory valuation and income determination. It's very good at that, and financial statements are required to adopt that convention. But let's say that we show the production run from 1 brick to 1,000,000 bricks and calculate what the cost per unit would be. So if we made only 1 brick, we would add $1 of materials plus $100,000 of fixed overhead for the year's depreciation, and that 1 brick would cost $100,001. Continuing, if we made 100 bricks, we would add $1 for each brick, incur $100 of materials costs and $100,000 of depreciation. To figure the cost per brick, we would take 100 divided by the $100 of material and get $1, and we would take the 100 bricks and divide it into the $100,000 of overhead cost to get $1,000 as the allocated fixed costs, and we would have a total of 1,001 bricks. Continuing on, what you would see is that if we increase production to 1,000, 10,000, 100,000, and even 1,000,000, dividing the total variable costs for materials by the number of units that were produced, in each case, the variable cost per unit would stay the same at $1 per unit. But as we would take the units produced and divide it by the fixed cost for manufacturing, 100,000, which stays the same regardless of the number of units we make, the fixed cost per unit decreases with the increase in the number of units that are produced, so that the total unit manufacturing cost will decrease as the volume increases. The point that we are illustrating here is that although GAAP accounting may be good for inventory valuation and income determination, it is not so good for decision making because it combines fixed and variable costs together. Specifically, what causes problems is that the full absorption costing unitizes fixed cost, and it pretends like fixed costs are driven by volume and not by what they truly are, by time. Now, let's just carry this one step further. Let's suppose that of the number of bricks that are being made, the company can sell 3/4 of everything that it makes, so that 1/4 of what it makes is an ending inventory. So if the company sells 100 units, it will sell 75 and have 25 left over. If the company would sell or make 100,000 units, it would sell 3/4 of that, 75,000 units, and have 25,000 left over, and so forth. Okay, now let's see what the ending inventory would look like under full absorption costing. We would take the number of units in ending inventory in each of the cases, and then multiply that ending inventory by the total full absorption cost per unit. And in doing so, you can see that the ending inventory is going to build as the number of units increases. Now, that's not bad for inventory valuation purposes, but for decision making, it combines fixed costs and variable costs because of the unitized fixed cost, and that doesn't make good business sense. So, let's enter variable costing. The key behind variable costing is that only the variable manufacturing costs are inventoried. In other words, fixed costs are always expensed in total in the year that they are incurred. So what variable costing does not do, it avoids unitizing fixed costs. By expensing all fixed costs in the period that they are incurred, and only inventorying the variable cost per unit, in this case just the materials, here's what happens to ending inventory. We have 25 units of ending inventory in the first period at $1. The ending finished goods will be $25. In the case where there will be 25,000 units in ending inventory, each would be valued at only the variable cost of materials $1, and so you would have 25,000. Okay, so we've isolated cost by cost behavior. Variable costs vary by volume. Fixed costs vary because of time. Now, let's take a look at the difference between the two inventory values. Full absorption costing when the company makes 100 units as $25,025. Compare that to only the $25 under variable costing, and you get a difference of $25,000. Doing that again for 10,000 units, under the 10,000 unit level, GAAP would show 27,500 as the ending inventory. Variable costing, when 10,000 units are produced, shows only 2,500. The difference between the two is $25,000. Here's what you note. In each of the volume levels, the difference between full absorption accounting and variable costing is the amount of fixed costs that is allocated to ending inventory under full absorption costing. So, if we would take the finished units in ending inventory in each of the volume levels and multiply it by the fixed cost per unit at each of the volume levels, we would indicate the amount of fixed cost allocated to ending inventory and will always show the difference between full absorption costing and variable costing. So, to summarize, what's the takeaway point? Variable costing is used as an internal use only tool to segregate variable costs, which are driven by volume, from fixed costs, which are driven by time. If a manager makes a decision by volume, that manager can control variable costs. On the other hand, if a manager makes a decision about time, then that manager can control fixed costs. If the income statement separates variable costs from fixed costs, then the manager can very easily see which costs he or she can control by either controlling volume for the variable costs or time for the fixed costs. There you have the assumptions behind variable costing. Give the exercises a shot. Do well.